Hey, it's Darius, and congratulations to I-75ers who let me know that they passed the CPA exam this month and also last month. Like you, they got a little stuck out there on the CPA exam journey. They came to me and they said, "Hey, Darius, you got to help me like you've helped my friend and so many others." So I got them on I-75, they passed, and they were happy to share the good news. So I'll save a spot for you on next month's list. So if you didn't pass, don't get mad. Get yourself on the right road with me, Darius Clark, because the right teacher makes all the difference. The most important part of the whole audit exam are these transaction cycles. They're always tested in simulation. You have to know the basics. We're going to start with the revenue cycle, and in this video, we'll go over the departments, the documents, and some of the control activities in that cycle. Transaction cycles help auditors assess risk, help evaluate internal controls, and design audit procedures to ensure accurate financial reporting and fraud prevention. So by understanding how transactions flow through the business, auditors can identify high-risk areas where the errors or the fraud may occur. Auditors gather evidence one transaction cycle at a time, usually starting with the revenue cycle. So that's why on the exam we got to get familiar with the documents, the departments within the client's cycle, because the auditor is looking for proper authorization, approvals, and control activities that ensure segregation of duties. Why? Because the auditor is trying to assess control risk within the departments and within the entire cycle. Each document will have copies sent to various different departments. And that's why we got to get to know the documents, the departments, and the control activities in each cycle. So the revenue cycle involves activities related to the sale of goods and the collection of payment. It includes the following major departments. We got the sales department, which receives the customer order and prepares the initial document in the revenue cycle, which is the sales order form. And you've got to know that the sales order form is the first document in the revenue cycle. So we go from the sales department to credit, because the credit manager should determine whether the customer has the ability to pay. If credit is approved, then the sales order is approved by the credit department. Because most sales do not involve a credit card when they're business to business. They're usually trade credit is involved. 2% off if paid within 10 days, but 30 days to pay regardless if you take advantage of the discount or not. But companies should only extend 30 days of trade credit to customers who are worthy. And that's why we need a credit department. The credit manager's job is to determine whether the customer has the ability to pay. If the credit's approved, that's good news. The sales order is approved, and then one copy of the sales order goes to the warehouse, and one copy is going to go to the shipping department. So the warehouse has custody of all the inventory. They ensure order fulfillment. The warehouse acts as the link between sales order processing and eventual shipping. Warehouse ensures that only authorized goods are picked, packed, and sent to shipping. Warehouse should not be allowed to move goods outside the company, because that job is the shipping department. Shipping of goods, delivering products or services to the customer or to the carrier like UPS. Now, one more thing about shipping. They should match the sales order received from the credit department to the sales order received from the warehouse. If they reconcile, then shipping prepares the bill of lading, which you have to know is considered the second major document in the revenue cycle. So let's say the customer was approved for 100 cases of Snapple iced tea. So that means 100 cases got picked from the warehouse and sent over to the shipping department. Now the shipping department has to match the sales order received from the credit department, which says that the customer was approved for 100 cases of Snapple, and compare that to what they received from the warehouse that said, here's 100 cases of Snapple. And if the two documents reconcile, then shipping should prepare that bill of lading, which is considered the second major document in the revenue cycle. What was the first document? The sales order. Now, a couple of more departments. So we got to the shipping department. That's where we left off. We said they prepare the bill of lading, which is the second document in the cycle. But then we got the billing department, which is accounting. They need a copy of both the sales order and they need a copy of the bill of lading. So the billing department's job is to compare the sales order to the bill of lading, and if they match, then the billing department prepares the third document in the cycle, known as the sales invoice, and sends the sales invoice to the customer so that the company can get paid and the billings department can record revenue, but not before the goods are shipped. So now we know there's three documents in the revenue cycle: the sales order, the bill of lading, and the sales invoice. What about accounts receivable? Well, if they're not already part of the billing department, they could be separate. They would ensure that payments from customers are properly recorded and that outstanding balances are monitored. Accounts receivable would track any overdue accounts and prepare the accounts receivable aging reports. All right, in what sequence are the following documents typically prepared in the revenue cycle? A, sales invoice, bill of lading, sales order. B, sales order, then sales invoice, then bill of lading. C, sales order, then bill of lading, then sales invoice. D, bill of lading, then sales order, then sales invoice. And the answer is C, the sales orders first, followed by the bill of lading, and then the sales invoice. And the reason why it's important to know the sequence is because later on when we do the two-directional testing for overstatement and understatement, the exam's going to expect you to know, where does the auditor start the test? If they're looking for overstatement, do they start with the sales invoice? Or if they're looking for understatement, do they start with the sales order? So that's coming later, but right now you have to know the sequence of the documents and which department prepared them. For example, the sales order gets prepared in the sales department, the bill of lading gets created in the shipping department, and the sales invoice is created by the billing department. And the question asked, in what sequence are the following documents typically prepared in the revenue cycle? And the answer is sales order first, then bill of lading, followed by the sales invoice. Now there's two other documents in the revenue cycle that you might see tested. One is the picking list, and the next one is the packing slip. And while it's more likely to appear as a wrong answer choice, you got to know what it means so you don't choose it. So a picking list is created automatically in a warehouse management system once the sales order is approved. Picking list shows the items that need to be picked from the warehouse using barcode or RFID tagging, and this transmits data from the tag to the computer. So a picking list is an internal document. The customer never receives a copy of it, but it is important for warehouse management. So which department do you think will be using the picking list? Yeah, the warehouse. What about the packing slip? Well, the packing slip lists the contents being shipped and is used to verify that the correct items were packed before shipping. So a copy of the packing slip is usually included in the shipment for the customer. The packing slip is created after the items are picked and packed. Now, the shipping department, which prepares the bill of lading, should compare the packing slip with the sales order and the bill of lading before finalizing the shipment. All right, what document is issued by the billing department to request payment from a customer? Is that A, a picking slip, B, a sales invoice, C, the bill of lading, or D, the sales order? And that's letter B, the sales invoice. The billing department issues a sales invoice to request payment from the customer. So after the goods are shipped, the company wants to get paid. So the billing department compares the bill of lading to the approved sales order, and if they match, a sales invoice is prepared and sent to the customer. So if you're working in the billings department and you pick up the bill of lading that just got sent to you from the shipping department and it says, we just shipped out 100 cases of Snapple iced tea, and then you pick up a copy of the approved sales order which came to you from the credit department and it says the customer's been approved for 100 cases of Snapple iced tea. If they match, then you in the billings department prepare a sales invoice and you send it to the customer. A is wrong. A picking slip is used by the warehouse to retrieve goods for shipment, but it does not request payment. It's an internal document. It never leaves the company. And C is wrong. A bill of lading is a document issued by the shipping department as proof of shipment. It's not for billing purposes for the customer. And D is wrong. The sales order is created by the sales department to record a customer's purchase request, but it does not request payment from the customer. And the question asked, what document is issued by the billing department to request payment from a customer? And the answer is the sales invoice, letter B. All right, in the revenue cycle, which of the following is a legally binding contract between the shipper and the carrier, which serves as the proof of shipment? Is that the sales order, the picking list, the bill of lading, or the packing slip? And the answer is bill of lading, letter C. You've got to know that the bill of lading is a legally binding contract between the shipper and the carrier.
It serves as proof of shipment and includes details such as the type and quantity of the goods shipped, the destination of the shipment, the responsibilities of the carrier, and the bill of lading is required for resolving disputes related to loss, damage, or misdelivery of goods. A is wrong. The sales order is not a binding agreement between the seller and a third-party carrier. B is wrong. A picking list is not a legal document. A picking list is used internally in the warehouse to retrieve the correct items for shipment. Picking list does not create a legal obligation with an external party. And D is wrong. A packing slip is not a legal document. It lists the items included in the shipment, but it does not serve as a contract or proof of delivery. It's informational only, and it's typically included in the shipment for the customer's benefit. And the question asked in the revenue cycle, which of the following is a legally binding contract between the shipper, who's the seller, and the carrier, who's the transportation company, which serves as a proof of shipment? And the answer is C, bill of lading. All right, the shipping department should be responsible for all of the following, except A, verifying goods against sales orders, B, generating a bill of lading, C, approving credit sales, D, sending goods to customers. And the answer is C, approving credit sales. Because approving credit sales is the responsibility of the credit department, which assesses the financial standing of a customer before authorizing a sale on credit. The shipping department should only ship goods after credit approval has been granted. A is wrong. The shipping department is responsible for verifying goods against sales orders to ensure the correct items and quantities are shipped. B is wrong. The shipping department is responsible for generating a bill of lading, which serves as a contract and receipt for the shipment. And D is wrong. The shipping department is responsible for sending goods to customers by coordinating with carriers and ensuring timely delivery. The question asked, the shipping department should be responsible for all of the following except, and the answer is C, approving credit sales. All right, in the revenue cycle, which of the following best differentiates the warehouse and shipping departments in terms of their primary responsibilities? A, the warehouse department is responsible for sending goods to customers, while the shipping department stores and tracks inventory. B, the warehouse department manages inventory storage and selection, while the shipping department ensures goods are properly transported. C, the warehouse department handles credit approvals, while the shipping department manages billing. D, the warehouse department prepares invoices, while the shipping department determines customer credit. And the answer is B, the warehouse department manages inventory storage and selection, while the shipping department ensures goods are properly transported. A is wrong. A says the warehouse is responsible for sending goods to customers. No. The shipping department, not the warehouse, is responsible for delivering goods outside the company. The warehouse should never be allowed to send goods outside the company. The only thing the warehouse should be able to do is send goods to the shipping department, or maybe if there's a couple of company-owned stores, the warehouse can send the goods to the company-owned stores, and then they can go back to the warehouse, but the warehouse should never be able to send goods outside the company. C is wrong. Credit approvals are managed by the credit department, not the warehouse. Billing is handled by the billing department, not the shipping department. And D is wrong. Billing prepares sales invoices. The credit department determines creditworthiness, not shipping. And the question asked in the revenue cycle, which of the following best differentiates the warehouse and shipping departments in terms of their primary responsibilities? And B says it best. The warehouse department manages inventory storage and selection, while the shipping department ensures goods are properly transported. All right, which of the following is not a primary function of the sales department in the revenue cycle? A, initiating customer orders. B, approving customer credit. C, communicating orders to the warehouse. D, processing customer returns.
And if you think you know, leave me the answer in the comments or community section. And if you found this video from I-75 Audit helpful and you want to see the rest of it and more videos like it, just go to i75cpareview.com and get yourself on the right road to passing audit. Get on I-75 with me, Darius Clark, because the right teacher makes all the difference. I'll go ahead and leave a link in the description. I'll save a spot on the list for you next month.